Good afternoon, everybody, and those of you in a different time zone, it may still be good morning to you. This is Glenn Mather. I'm founder and CEO of Newview Trust. And as a steady diet of educational material, I'm really excited about what we're going to cover here today. And during this discussion, I just want you to understand that you're really blessed by the fact that we're not lawyers or CPAs. That's going to make this a heck of a lot more interesting. But not only that, it basically means that we don't understand you and your particular needs. So that's best to go discuss that with your lawyer and CPA, and you're welcome to do that after you hear our discussion. But what we do here is we hold people's retirement plans. We have $1.5 billion of client assets. And the reason they're on our platform is they want to buy things outside the stock market. They're convinced that they can do better on their own, making their own choices in a far more broad array of choices. And that's actually why we have Ben here to talk about one of my favorite subjects. So we're a fully regulated public trust company. We've been at the business for 17 years. I actually started it. It was just me when we started it. And we built up an absolute great army of people to help you provide custody of your IRAs. And we try to be simple, available, and responsive to you. If you have any questions at all about how this all works, there'll be people here in the office after you see this event, certainly during daylight hours, that'll be able to help you. So what I want to do next is quickly get to Ben, because I think that's why most people came. It wasn't for me. But we have Ben Frazier here, and he's Vice President of Aspen Funds. And it always impresses me when I see dollar signs and I see millions and I see like numbers like 50 and 125 million, all these things going on. But what I like most about Ben is when he's talking about debt, and this is debt that you can actually, not debt that you're incurring for yourself, but it's actually debt that you're buying that other people have incurred. Through this process, I've gotten to know a lot of people that have invested in debt of one type or another. And they always seem to do better than other people. And I have no idea why. And I think it's sort of like that very simplified, steady process that debt investing gets you into. It's not the fast buck. It's not the flipping a house or trying to find the stock that's going to go up by 700%. It's much more of a steady process. And I'm kind of drawn to it too because I love spreadsheets. And I'll bet Ben likes spreadsheets too. Something would tell me that he enjoys that too. But in any case, we're going to learn about this together. Now, we are a platform for self-directed IRAs and retirement plans. And the reason that this particular subject's very interesting to us is because when your money's in a retirement plan and has a custodian such as Newview, it means that as you make money, you don't have the tax toll gate going up every year. And especially in debt financing, it's very hard to escape the tax man unless it's in a self-directed IRA. So you can choose to do this on your own. In other words, we have people that actually issue mortgages, issue second mortgages, buy distressed debt. Some of the things that you're going to talk that Ben's going to cover, you can do this on your own, one by one. What we find is most people don't have time to do that, or they don't have time to create the expertise within themselves to do it. So they find funds and they find partnerships and they find other ways to join together with people that may know more about it than they do. And funds are created. And this is one of the things that Ben's going to talk about. And what I like about Ben is he was an underwriter before he was in the fund management business. So because of that, the underwriter is the one that determines whether or not an individual or a company or entity has the resources to be able to pay back the loan. Is it a good risk? What are the rates? What's the underlying assets worth? And that's the excitement that basically Ben does that. He learns how to do that in the past. His company now does it, but not just for single investments, for multiple investments. So Ben, once again, welcome to Newview and our friends from Newview, and can't wait to hear what you've got to say.
Awesome. Thanks so much, Glenn. And thank you all for joining. Really excited to spend a few minutes with you and talk about this subject that we're pretty excited about at Aspen, and a lot of investors are thinking about it, right? Distressed assets are on a lot of investors' radar. And at this point in the economic cycle and this environment, it's something that a lot of investors are curious about, right? Where can I find good deals on assets that are in distress. And this is a strategy that Aspen Funds has been operating for about 8 years now, and we're actually getting ready to launch a new fund in a few months in this strategy. So it kind of worked out great to talk about this strategy in distressed debt. And some of you may be familiar with real estate note investing. This is what I call kind of a niche within a niche. It's very specific subset of real estate note investing. So I'm going to get into the strategy of how it works, and if you want to do that actively on your own or through a fund like ours, that's something which we'll have information at the end to talk about. So I'm going to go through the presentation. At the very end, we're going to open it up for questions, and I'll take those live. This is also recorded, so excited to jump in here. So just real quick, a little bit on Aspen Funds. If you haven't seen my presentations on Aspen prior, a little bit about us. These are our two co-founders, Bob Fraser, Jim Mafuccio. And really what Glenn was saying is looking for the alternative assets that can produce outsized returns. That was the whole impetus behind starting Aspen. Jim, his background was 30 years in real estate as a developer in California, and he got hit pretty hard in the 08-09 crash, right? In development, real estate in California in particular got hit very hard. And so he was pondering, what do I do next? And how do I get on the other side of the debt equation? And how do I become the lender and not be the borrower? Because the lenders generally seem to come out with less scars than borrowers. And it kind of spawned the interest into this particular strategy I'm going to get into. And it was the first strategy that Aspen started in. And he met with Bob somewhat serendipitously. Bob's background was in technology and finance. He was managing a hedge fund at the time. And at that point in time, there was a lot of volatility in the market and was looking for something that was insulated from that. And Jim brought this opportunity together, and the rest is history. So they raised the first fund with friends and family. And since then, have grown quite a bit. We hit the Inc. 5000 last year. We've got an 8-year track record. We've got a pretty big staff, a great experience. We've purchased over 2,500 assets in 45 states, and do this all mostly or 100% passive for investors. And that's just a little bit about us. But now for the real meat of it, and what you're really here for is talking about investing in distressed junior liens. So when I say that, the first thought may be, why would you ever invest in a non-performing junior lien? And that's what I'm here to tell you. So what we call these are NP2 SPs, kind of an acronym for a non-performing second mortgage behind a performing senior mortgage. And so when I talk about, the niche within a niche, this is really where we focus on, and, other investors in this space focus on. And there's a lot of reasons I'm going to get into why this makes a whole lot of sense. But these are mortgages where the subject lien or the second lien is not being paid, but they are paying on their first mortgage. And so what happened is this, if you go back to the last crash, when the real estate market was on a tear, everyone was taking out second mortgages, and assuming that the real estate market was going to go up into perpetuity, which it obviously didn't. And when the market corrected, a lot of those borrowers got hit hard. They stopped paying the second mortgage, but kept paying the first because they wanted to stay in their home. And so if you kind of go to why do these exist, that was kind of the genesis of a lot of these. But there's kind of an ongoing amount of non-performing second mortgages at any point in time in the market. And what happens is these homeowners run into challenges. They stop paying their second mortgage, but they keep paying their first because they bank on the fact that banks will not foreclose from second position, and they keep paying the first mortgage, and so they can stay in the home. Well, banks, don't really have the expertise to work out these assets, even though they have the ability to foreclose from second position. They have all the rights as a junior lender as they do with as a senior lender. They will write them off generally. And writing off to a bank means they'll write these down to either a zero value or a very minimal value. And because of that, they're willing to sell them at very deep discounts. And then, the other side of this equation is there's a fairly large universe of these assets, but it's not It's not hundreds of billions, right? There's, I believe it's around $7 to $9 billion of non-performing seconds on banks' balance sheets right now. And that's a little bit too small of a market for a lot of the big hedge funds to play in. So it keeps out a lot of the big money out of this space, and more, middle market firms like us, and then individual investors can play here and get some pretty nice risk-adjusted returns. Another, just kind of why this asset class, if a borrower is paying on their first mortgage, but not on their second mortgage, a few things. One, the home is occupied, which is very important. Two, it's a very strong indicator that the homeowner wants to stay in the house and will be willing to make a deal with you. And three, they have a source of income by which they're making the payments on the first mortgage. So with them paying on that senior mortgage, there's a lot of indicators that are going to help you in negotiating with these borrowers. And then there's three value drivers. So on the next slide, I'll kind of walk through this in a visual way, but these assets actually become more valuable over time. And it's a function of three things. One is, if they're not paying our mortgage, our lien, they are accruing late fees and interest and arrearages that continue to grow over time. As they're paying that first mortgage, they are paying down the principal, which is increasing what we call the collectible equity above that first mortgage. And then two, to the extent that home prices continue to rise, that further increases the equity that makes it more incentivizing for the borrowers to stay and to protect their equity and work a deal out with us. So here's kind of the visualization of that. And, here's those three things that I was mentioning. Interest continues to accrue, first mortgage is getting paid down, and the gains in the home value increase equity. So here's the first mortgage right here. You can see, every month they're chipping away at that principal, and it's going down. A lot of times these mortgages, their first mortgage is in the late stage of the amortization period. So if you understand kind of the amortization curve of a mortgage, you don't pay much principal down early on, and then at the end you're paying a lot of principal, and this is the balance of your mortgage. And it goes down faster over time. The second mortgage, see, it continues to increase over time because of late fees. And then this is the home value. So as the home value continues to go up, that increases the collectible equity. So the real key thing to understand here, as long as the first mortgage continues to be paid, your position gets more valuable. So we'll get into more of this later. But the other kind of interesting factor here, and something we'll get into in a little bit, is the owner-occupied difference of these types of assets. So because these are homeowners and not investors, they're much more willing to make a deal, even if the numbers don't always make sense. And I'll get to an example later on in a case study that we have where the borrower actually had negative equity, which we don't do all the time. But sometimes if the numbers make sense, we will. And worked out a great deal, and they want to stay in the home. And the reason is what we call emotional equity, right? And these emotional attachments that homeowners have to their homes, right? This is where they grew up, where their kids go to school, where they have a job that's not easily relocated. And it makes it much less cyclical and volatile, as opposed to, hard money lending or something where it's an investor that, if an investor is in a property and the market crashes and there's no more equity or profit to be made, they're much more likely to hand the keys back to the lender. Well, in a situation with a homeowner, that's not the case. And we've, proven this out for over 8 years and, the 800 or 900 assets that we've exited. The other kind of factor we look at in something to consider when you're purchasing these is equivalent market rent. So a lot of times the borrower's monthly payments are going to be less than the market rent in their area. And so it creates an additional stickiness factor for these borrowers to stay in the home, avoid foreclosure, and work out a deal with you. Oops, getting stuck here. Oh. All right, here we go. So here's a survey that was done by the New York Fed several years ago. This is just really interesting. They surveyed homeowners, after the last crash, who had little to no equity in their properties, and asked, why do you keep paying your mortgage, right? On the surface, it seems counterintuitive, but then if you really think about it, if your home all of a sudden dropped 50% in value, would you just stop paying your mortgage just because it dropped in value? No, you're going to keep paying it because it's your home. You have to have a roof over your head, right? The value is somewhat inconsequential. And the number one reason here you can see is an emotional reason of why they keep paying even when they're underwater. It's, I like my home and I don't want to lose it. And so it kind of underpins this whole point of, emotional equity. And, these assets are generally much less cyclical. One question a lot of investors immediately go to is, well, what was the peak default rate in after the 2008, 2009 crash? And a lot of investors would imagine that number was 10%, 15% of mortgages defaulted, meaning they stopped paying and they had to be charged off and foreclosed on. Well, this is actually from the Federal Reserve, and you can see here it peaked at the end of 2009 at a little over 2.5%. And that number is a little bit confusing, right? Because a lot of us would imagine it'd be much higher based on the effect that it had on the whole economy. And you have to understand banking, which that's my background. And the way that banks are run and set up is they operate on what's called a net interest margin, which is basically their cost of funds, relative to how much they earn in interest on the funds that they lend out. And it's a very minimal amount, and they can only sustain a very small amount of charge-offs or write-offs. And a 2.5% number is a very big number, and it created this whole domino effect in the banking system. But for someone like us who is buying these at a 80% discount, or any investor is buying these at a 70 to 80% discount, that's not that dramatic. And it kind of underscores the point again of people keep paying generally. Most borrowers are going to find a way to keep paying their mortgage and get back on track. Okay, so here's kind of the 5 primary workout strategies. And so this is what we do at Aspen. This was a lot of investors. These are kind of the 5 core strategies that you work out. So you buy this asset, the borrower's paying their first mortgage, they're not paying the second. Well, what you do is you reach out to the borrower and you start a conversation and you figure out, what's going on, what caused you to stop paying, what resources do you have that we can work with, and you can put together a deal. And it usually will fall into one of these categories. The most common for us is what we call a reperform and sell. What we do is we put together a loan modification, right? We put together terms that they can afford. We get a whole package from them and, have them start paying again. They put a good faith payment in after a period of time. That note is considered seasoned and performing, and that can be sold as a performing asset back to the secondary market. And you usually make a pretty good return doing that. The second most common strategy for us is a discounted settlement or a payoff. This is just getting a lump sum payment from the borrower. So, say that the borrower owes $100,000. Sorry for my mouse writing here. And you purchase the asset for $20,000. Well, that gives you a lot of margin to work with. And a lot of times in this case, we'll take, say we'll knock that $100,000 down to $60,000. And so they're really happy because they get to wipe out $40,000 of debt. And we're really happy because we just tripled our money in that case. So that's a very common scenario. The other is we call it quick resale. This is more probably relevant to a firm like ours that's buying these in bulk. We can flip these out for a quick margin because we can buy them wholesale. The next one is a short sale, a friendly short sale as we call it, where say the borrower doesn't have enough equity, but there's still equity to cover a good amount of what they owe you. You can write down a little bit of what they owe you, similar to the settlement, right? But the mechanism for payoff is a new loan versus just cash coming out. And then ultimately it's foreclosure, right? And so a lot of people, once we get to this point, think, hey, you're probably foreclosing on what, 20% of your mortgages in any given time period. Historically, we've actually only foreclosed on 2% of the mortgages that we buy. And again, it's because these borrowers, they want to stay in their homes generally, and they're going to figure out a way to do it. And because of the really deep discount, you can make really good margins and have a lot of room to play with these borrowers. So now we're getting into some actual case studies. I have 3 case studies here, and this should hopefully illuminate some of the things I'm talking about. So this is a case study. This is a loan modification that we put together and sold. And this is what we call partial equity. So we have there are 3 different categorizations. One is negative equity, partial equity, full equity. I have one of each of those, and I'll show you here in a sec. So you can see here the home value is worth $274. The first mortgage is $235. Second mortgage is about $48. So we buy this second mortgage for $7,600. We bought this in 2014. So that's an 84% discount. That's a pretty nice discount. And you can see there's equity to cover all of our purchase price, but not quite to cover the full balance of the second mortgage. Right? So this is what we call partial equity. So in this situation, we reached out to the borrower. We worked out with them what they wanted to do. They wanted to stay in the home. They wanted to figure out a way to make payments again. So, fast forward about 18 months later or so, 20 months later, and the home has gone up in value. It's in a great part of Florida, and it's gone up a little bit. So here's our 3 value drivers again, right? 3 value drivers we talked about earlier. Home value had gone up, increased equity. First mortgage had been paid down a little bit. Second mortgage had increased. You can see from here to here, this is just from late fees and interest accruing. And you can see here, the equity now has increased quite a bit above that first mortgage. And so what we did here is they did a loan modification. They started paying again. Once they'd been seasoning those payments, we sold that as a performing loan for about $32,000. And, made a nice profit here, a great revenue multiple. You can see why in an IRA, this makes a lot of sense. A lot of times these are long-term capital gains. And so it can be, very advantageous, especially with these kind of multiples in an IRA. Here's another one. And this one always kind of boggles people's minds. This is a negative equity. And so we don't buy a whole lot of these, but if the numbers make sense, we will. This one was a settlement. So this one is in New Jersey. The home was worth right about $400,000. But they owed $485,000, right? So they're already underwater. They had a second mortgage on top of that. Well, we bought that second mortgage for about $10,000, 90% discount. So very big discount. You can see negative equity. So it's higher risk. But in our due diligence, we had a really good indicator this person wanted to stay in their home, that they had the means to do so. And so we worked out a deal with them. Looks like about 2 years and a few months later, the home had increased a little bit, had gone up, and the first mortgage had been paid down. And the second mortgage had also, the balance had gone up from late fees and interest. And so you can see there's still negative equity, but there's more to work with. We're getting close to break even. Well, this borrower wanted to stay in the home. We negotiated a discounted payoff amount. So they just paid us $40,000. They owed us $130,000. So you can imagine from this borrower's standpoint, this was a huge win for them, a huge windfall for them to be able to knock out $90,000 of debt. And we walk away, and then we're happy because we made, nearly a 4x multiple on that. Next one I'll show here is this is a full payoff. This happens every so often, which is great when there's deep equity. So you can see here, this is in New York. The home was worth about $330,000. The first mortgage was $71,000, so they paid that down a lot. Second mortgage worth about $57,000. We purchased that about $17,000, about a 69% discount, right? So there's a lot of equity here. There's not a whole lot of ways you can lose in this situation. And looks about just very, very short time period after we purchased this, they were already looking to sell the home. So it kind of worked out great. And they sold the home, and we got fully paid off. So, right, because we bought it for $17,000, but they owed us $56,000. So we got the $56,000. We bought it for 17. Again, a nice profit, and great returns there. And that one happened very quickly. So I'm going to show you some general FAQs, and then we'll go straight into Q&A. And I kind of already hit on this a little bit, but why are the notes sold at a discount, right? That's somewhat of a disconnect for some investors. There is an active secondary market, but it is still fairly inefficient. And like I was saying a little bit ago, there are regulatory hurdles that keep a lot of kind of middle market players like us out of of it because you have to have a certain level of infrastructure and expertise to do it at our level. For individual investors, it's not as much. You can kind of get away with buying mostly in your own state and other things, but there's not a lot of big players. So it's an inefficient market. And the banks, again, they're not well equipped or knowledgeable on how to handle these, even though you can foreclose, and we've done it, a lot of times from second position, they won't. And I'm not going to get into that on this, presentation on how you do that, but I'm happy to have that conversation offline. And ultimately, the banks, they're managing their risk. They have regulators that are pushing on them to keep their ratios a certain way, and they'll write these down. And when writing them down, now the value of these assets is pretty close to zero. So when they sell these for, even though it's a 70 to 80% discount to what's owed, it's actually a 20 to 30% gain on sale of a written off asset. So it's actually a win-win-win for everybody involved. Where do I buy notes, right? So this is, the most logical next question. So Aspen, we don't have any coaching programs for, how to buy these on your own. There are a lot out there, and a lot of those will teach you how to, go call banks and build relationships and get access to these. There's also hedge funds and other kind of intermediaries that you can build relationships with. And there's also note trading platforms where you can go online, and there's these exchanges where you can go buy these. The one big caveat I'll put here is this is something that if you do want to get into, it's very important you do a lot of due diligence on the front end, and you really spend the time learning these assets, because there are a lot of factors involved, right? There's consumer compliance laws you got to be aware of. There's mortgage licenses in different states. There's foreclosure laws that are different in every state. And, these are somewhat highly regulated. So you have to know what you're doing. But the returns can be very rewarding for these types of assets. What about the housing market, right? Everyone's curious about where does the housing market go, especially in this kind of post-COVID area, or, soon to be post-COVID area, hopefully. I'm not gonna spend a whole lot of time on this because I want to get to the Q&A, but I will say at the end of this presentation, I do have a link for any of the attendees here that you can go and download a few freebies, but we also have a 2021 economic forecast that we just published. And that is readily available. It's all free. It's a 6-part series. And one of those parts, we cover the housing market. But ultimately, we've been talking about this long-term thesis for a while, and, have a lot of data to support it. But ultimately, there's been a big undersupply of single-family properties being built over the past 10 years. And it's been driven by the fixed costs of real estate development going up. Land, labor, and lumber have all increased in cost. So supply has been suppressed for a long time. And that was kind of what this chart is here. The blue line is the new starts for multifamily properties, and the red is single family. So you can see, pre 2008, it was on a tear and it dropped off, and it's never really recovered, right? It's kind of back up maybe to par, but there's still this whole kind of gap that's needs to be filled before the imbalance normalizes. Also, with the cheap interest rates being offered by the Fed and likely to be offered for some time, that's increasing demand, making it cheaper to afford. And so we actually are pretty bullish on the housing market in most areas. Lastly, on the active versus passive. So just to kind of reiterate this point, we do not facilitate active purchasing of these assets. So, we are a seller of mortgages. So, we do have a trade desk that periodically will put out trades if you want to go on the active side of it. But at a minimum, we can point you in the right direction. If that's kind of the route you want to go, we can point you in the right direction to those resources that are going to be most helpful to kind of get started here. We're really focused on the passive approach, and it's really a decision for every investor of whether you want to go active or passive. And it's, do you want to spend the time and effort and energy to do it yourself, or, leverage a, sponsor or manager's team like ours to go do it. We have 25 staff. It's mostly all ex-bankers and ex-attorneys. And that's all we do. We only manage note funds, and we manage all the assets. We're doing all the borrower phone calls. And then one of the big challenges is finding deal flow, right? It's, if you don't have super deep pockets, it can be hard to find assets. That's why a lot of even active investors will participate in our funds as well as, actively invest themselves. But it is possible, and definitely something to, if you're interested in, we're happy to have a conversation to kind of point you in the right direction. And so I think we're good. Grace, I think I hit my time limit, so I talked very fast. So sorry for anyone that was trying to keep up that didn't. But I'll kind of pause there just real quick before we go to questions. This is the landing page I was referencing for anyone here. If you go to www.aspenfunds.us/newview, that is a landing page that will have all these resources. So we have a free mortgage note investing guide you can download. You can see our economic forecast there. We're also, putting together a new growth fund that's using this specific strategy. We can share a lot more detailed information about, performance, those kind of things, if that's of interest. And you can get on the wait list there. And then you can also reach out directly to me. That's my email right there. It'll go straight to my inbox, Ben Frazier at aspenfunds.us. So with that, I'll open it to questions. So I already see a few questions coming in here. This is great. And if you guys want to, I think Grace, maybe help out here on where they submit the questions. I think there's a button that will say Q&A. You can just type them right into there, and those will go straight to me and Grace, and I'll kind of take some of the first few here. So feel free to pop those in. I'll keep an eye out on them. So first one, when buying the second, how do you confirm if the first mortgage is paying? So yeah, great question. There's a few different ways to do that. A lot of times, the simplest way is a credit report. So when you're buying a mortgage, you are considered a lender if you have the right licenses, and you can pull credit on borrowers, and that will generally show you the most recent payment for their first mortgage. If it's not being reported in the credit report, which does happen every once in a while, but it's there's other ways you can get around it. I won't get into that right now, but that's kind of the simplest way. I do have a few questions on foreclosure, so I wasn't going to hit that, but I can do that. So not to get into too much detail on it, but when you're foreclosing from second, there's a few ways you can do it. One would be, a lot of investors assume you have to pay off the first mortgage, right, to then take possession of the property. Well, in most states, you actually have the ability to take possession of the property while the first mortgage is still in place. What we've done in a handful of situations is if the first mortgage is behind, we'll do a few things. One, if there's a lot of equity in a property, right, in that third example that I showed, where there's hundreds of thousands of dollars of equity covering our position, there's not a whole lot of risk. We would just let that go to foreclosure, go to the auction steps. And we put in probably a reserve minimum bid, so we make sure that we don't get underbid there. But we're fine letting that go to foreclosure and letting the first manage that. And it's very, very likely that we're going to get fully paid off and make probably a nice profit there. In a limited equity situation, you got to kind of evaluate what's the risk, what's the potential for reward here. If there's not a whole lot of equity, there's not a whole lot of options. But again, you're usually not paying a whole lot for those. If there is partial equity, then yeah, it's something you probably want to do. And what we've done in several situations is you can reinstate the first mortgage to protect your position as a second position lender, which basically means any past due payments, you can bring them current, and then you can manage the foreclosure process from second position and go through the whole steps there. And the first is going to be fine with that because they're obviously getting paid, and they have to get fully paid off before the second, junior lender gets paid anything. So there's no conflict there, and that has happened many times. So that's a little more technical, but that's very, very possible. Are there any issues with foreclosing during COVID? Yes, absolutely. So, that's really on a state by state level right now. There hasn't been any mandatory mandates from a foreclosure standpoint from a federal level, but it's really state by state. Obviously with Biden coming in, that'll probably be extended in a lot of areas. But again, like I mentioned earlier, I didn't get a lot of our historical track record, but we've only foreclosed on 2% of our assets, completed foreclosure. And so, it's something where it's just a wait and see game, right? Ultimately, these assets are generally getting more valuable over time. So if you're not super time conscious, it's not going to be a huge deal. And then as soon as, those moratoriums lift, there's going to be a flood. Active means I find my own deals. Correct. Yep. So if you want to be an active investor in these, that would mean you go purchase individual notes versus passive would be you invest in a fund like Aspen's. You become a part owner of a fund, which owns usually hundreds of assets. And so you get some diversification and you get to avoid all the headaches of doing this yourself. Is there a minimum buy-in to our fund? There is. I won't get into that right now just because I want to keep this high level. If you're interested in kind of, the fund that we may be rolling out, definitely check out the information there, and happy to have a conversation about the fund. Rates of return, open non-accredited investors. We unfortunately can only work with accredited investors. That's just kind of the securities laws that require us to do that. Rates of return, in our funds, historically we've generally hit around 15 to 20% annualized returns net to the investor. How do you get a hold of me? Yeah, there you go. You answered your own question there. Perfect. Yeah, my email address is right here. That's the easiest way to get a hold of me. Track record of our fund, that's on our website. And will also be, if you sign up for the wait list, you get information on all that. Yes, accredited investors, average return. So I think those are all the questions I've got so far. Anything else that you're seeing, Grace, or anyone else out watching this that has any other final questions here before we jump off? Awesome. Well, I'm not seeing any more come in. So great questions, everyone. Thank you all for joining. Happy to have a conversation again, whether, for your IRA, do you have to be accredited? Yes. Unfortunately, the accreditation rules apply to the individual generally. So it's, if the IRA is over $1 million, then that's no issue because you would be accredited. But yeah, unfortunately for to be accredited, you have to have either $1 million net worth or high income earner for the past 2 years, and the IRA is just a function of that. Minimum for investing. Yes, we have minimums. We usually, our stated minimums on the growth funds are usually higher in the $250,000 range, but we can waive that down. So we have flexibility there. We're not locked into that, so we can always discuss that. But last thing I'll say again is reach out to me if you have any more questions. Specifically, we have a lot of information on the website and on this landing page, and happy to answer any more. And if you are curious about kind of our next growth fund, I'm happy to put you on the wait list there. That should be automatic on that landing page, and look forward to hopefully talking with some of you guys soon. So thanks so much.